Most people have no idea that their home can actually be their largest tax shelter. And in today's video, I'm going to show you how you can write off a portion of your home expenses legally using the latest rules from the Big Beautiful Bill. I'm talking about expenses like your mortgage, your rent, your utilities, property taxes, even things like Wi-Fi, repairs and maintenance. All these things you can write off in 2026. Whether you rent your home or whether you own your home, there are several provisions in the tax code that may allow you to write off these type of expenses. And today we're going to break down everything in full so you have a full understanding of how you can save on taxes using your home in 2026. What's up, family? Welcome back to another episode of Tax Free Living. I'm your host, Carter Cofield, licensed CPA. And in the last 5 years, we've helped our clients save over $25 million in taxes. And today I am here to help you. So let me reiterate this right now. If you rent your home or if you own your home, there are still ways in the tax code that you can legally write off a portion of your home expenses. Most people think you need to rent or you need to own. You can do both, okay? And in this video, I'm gonna walk through 5 different strategies that you can utilize in 2026 that will allow you to reduce your taxes using your home. And we're gonna go from basic deductions that most people know, and then we're gonna end with advanced tax strategies that you've probably never heard of. And as a licensed CPA who does tax planning every single day, I've used this for myself and I use this for my clients. But today I wanna show you how you can use these to reduce your taxes. So let's start with the easiest one. Number 1, the mortgage interest deduction. Okay, so if you itemize on your tax return, the tax law may allow you to deduct 100% of your mortgage interest up to $750,000 of mortgage debt on your primary or your secondary home. So let's make this practical with an example. If you make $30,000 of mortgage payments during the year, and let's say that $15,000 of that amount went towards interest, which me and you both know is way more than that going towards interest, that $15,000 may be deductible on your taxes if you itemize, right? And that matters because a lot of homeowners think that their full mortgage payment is tax deductible. It's not. The key piece you need to realize is the interest portion of your mortgage is tax deductible. But the good news is this also applies to home equity loans or home equity lines of credit interest that you pay if you were to take out an extra line against your mortgage. So if you use these proceeds to build or improve your home, the interest on these loans is also deductible on your taxes. So this is the first reminder that not every home expense is deductible, but certain parts of your housing costs may be deductible. So what I want you to do is look at your mortgage statement, right? Look at the amortization statement. Look at how much you pay in principal, how much you pay in interest, and make sure that you're deducting that on your taxes if you itemize. And that brings us to number 2, which is the property tax deduction. Property taxes may be deductible through your state and local tax deduction, also known as the SALT deduction. Now, this is big because in the Big Beautiful Bill, the SALT cap went from $10,000 to $40,000, which means that if you pay a lot of money in property taxes, then you just had a big bump in the allowable deduction that you're able to take for your property taxes associated with your home. Now, this is another deduction that can create real tax savings for homeowners who itemize. And this is important because property taxes can get expensive fast. I live in Dallas, Texas. We have one of the highest property tax states in America. So if you live in a high property tax state, you definitely want to take advantage of this new SALT cap deduction because it can lead to major tax savings for you. And for some households, this deduction alone can be worth thousands of dollars in real tax savings. So right away, you can see a pattern here. Even at the most basic level, your home may already be creating tax benefits through number 1, your mortgage interest, number 2, your property taxes. And this is going to give a lot of taxpayers in 2026 the reason to itemize. And if you're working with a CPA, if you're working with a tax professional, make sure they're looking at this and not just defaulting you to the standard deduction, because this year, based on these new tax rules, itemizing could be the way for a lot of people. But let's be honest, these are still beginner level strategies. Now let's get into one that opens the door to writing off much bigger chunks of your homeowner costs. Which brings us to number 3, one of my personal favorite, the home office deduction. Now, this is where things get a lot more interesting, because if you have a dedicated space in your home that you use exclusively for business or exclusively being a 1099 contractor, you may be able to deduct a portion or all of the expenses related to this area on your taxes. And this includes things like rent, mortgage interest, property taxes, homeowners insurance, electricity, gas, water, internet repairs, maintenance. The list is long, which makes this one of the most powerful tax deductions available to business owners or 1099 contractors. But here's the key word that matters: exclusively. So for example, I'm recording this video from my home office. This entire room I use exclusively for business, which means that all expenses inside of this room are 100% deductible. My mic, my computer stand, my camera, these lights, my vibe board in the corner, everything in this room is 100% tax deductible because it is used exclusively for business. Now, the space of this room is also tax deductible. So my office represents about 25% of my entire apartment, which means that if my rent is $8,000 a month, which it is, I take $8,000 times 25%, and that gives me my real tax deductibility for my rent, which means that $2,000 a month is tax deductible. 2,000 times 12, that is $24,000 in expenses that I am able to write off in relation to my home. And that's excluding all of the assets that are inside of this room. So now you can see, like in real time, how major this home office deduction can be for business owners just like you. And I have to say this because every time I bring up the home office deduction, people say, well, isn't that a red flag for the IRS? Because the home office deduction is a red flag deduction. Hear me clearly. Okay, the home office deduction was a red flag deduction in the 1990s. Why? Because people weren't working from home that often. It is now 2026. The SBA just said 60% of business owners work from home. So the IRS also knows that we're living in a different era. So because of COVID and because of decentralized work, the home office deduction is no longer a red flag deduction. So please do not let your current accountant or your current CPA stop you from taking advantage of this deduction. Now, as a recap, before we go any further, we talked about mortgage deductions, which is available to W-2 employees and business owners. We talked about property taxes deductions, which is available to W-2 employees and business owners. And then we talked about the home office deduction, which is strictly for business owners and 1099 contractors. Now let's move on to number 4, which this strategy leaves people's jaw on the floor when I truly break it down. So let's get into it, which is the Augusta Rule. Now, this is one of the most talked about strategies because of how unique it is. In simple terms, the rule may allow you to rent out your personal residence to your business for 14 days or less, and your business gets the tax deduction, and you personally do not have to report this rental income on your tax return. So essentially it's a 2-for-1. Your business gets the deduction and you personally don't have to recognize the income, which makes this strategy so popular. Now, here's why business owners love this strategy. Because to keep your S Corp or your LLC in good standing with the IRS, you have to have annual meetings anyway. So now one of your annual meetings can be held in your primary residence. And that would count as one of the 14 business days that you can take advantage of using the Augusta Rule. So now business owners can get creative. They can say, hey, I'm gonna use one of the days to have my annual meeting. I'm gonna use another 10 of the days to record content. And I'm gonna use another 3 days to just host meetings with the rest of my staff, right? So you can find ways that you need to find an office space anyway to conduct these meetings with your team. You could just have these meetings in your home and take advantage of the Augusta Rule. And that way you get tax deductions and you get tax tax-free rental income. So here's a quick example on how we use this in our firm this year. So my business partner, George, he has a big mansion in the suburbs. And so the rent comps for his area are $2,000 a night, which means that he can rent out his primary residence to his business for 14 days at $2,000 a day. So we host all of our quarterly and monthly meetings with our team when they fly in town. This gives him a $28,000 tax deduction in his business, right? But it also gives him $28,000 of tax-free rental income. So you can see how this deduction can be major for business owners everywhere. And we're taking advantage of it every year. And I encourage you to take advantage of it as well. Which brings us to strategy number 5. Now, I'll be transparent. I have never talked about this strategy on the public internet before, but I said I really want this video to be special, so I'm going to break it down here. And the best way I can explain this strategy is with a real client story on how we implemented this strategy for her. So we had a client who was making good money in her business, like net income of north of $500,000. And we asked, what strategies are you willing to employ? And she said, I'm willing to do whatever it takes to get my tax bill down this year. So we decided to introduce her to something called the Self-Rental Loophole. The Self-Rental Loophole allows you to acquire a property and rent it out to yourself and be able to write off up to 30% of the value of that property against your small business income. Okay. So let me break this down and how it went in the story. So this young lady was a content creator and she was already paying $10,000 a month to rent a content studio. So we said, instead of giving $10,000 a month to some random owner, we're going to take advantage of the self-rental loophole, aka IRS Code Section 469-4, which allows her to purchase a commercial or residential property. The property was about $500,000. And then she purchased the property, which actually made her monthly costs go down, because instead of paying $10,000 a month, her mortgage was like $5,000 a month. So she actually saved $5,000 a month doing this. And because the owner of the property was the same owner of the business, we are able to do a cost segregation study on that property and write off 30% of the value of that property against her small business income. So for all intents and purposes, 30% of $500,000 is $150,000. So she got $150,000 for purchasing a content studio and leveraging this self-rental loophole. Now, she could also rent out that property to other guests, and so she can further monetize this property. But this is a strategy that 99% of accountants do not know or do not implement with their clients, but I wanted to give it to you as a bonus gift in this video. So let's bring it all together. If you rent your home or own your home, there are multiple ways to write off home related expenses, whether you own a business or not, right? We cover mortgage interest, property taxes, home office deduction, Augusta Rule, and the self-rental loophole. And some of these are simple, but some of these are advanced. And all of these combined can save you a lot of money for something you're paying for anyway, which is your home. Because the real win is not just finding deductions, but it's building a strategy that you can use year over year. So if you like this episode, please hit that subscribe button and check the link in the show notes to join our 5-day wealth workshop, where I'm going to be breaking down strategies just like these and so many more to help you minimize your taxes and maximize your wealth. Until next time, guys, peace.